record, and then I'm going to share a screen, and I'm going to share this screen. And all right, let's see if I can unmute people. All right. All right. So I'm going to go ahead and get started here, guys. Just real quick, can you give me a confirm that you guys can hear me and actually see what's going on? Because, you know, I don't want to be talking here for no reason, but just want to make sure that you guys can actually see everything on the screen and it all looks right and all that stuff.
Yeah, I hear you and I see the slides.
Okay, awesome, awesome. Okay, you can hear me and see the slides. Okay, great. Well,
Yep.
You know, thanks for, oh, let me click on the record button here. I don't think it's recording. Hold on one moment. Let me see here. Let me see, stop share. And then I got to go to record. Okay, great. It's recording. Just making sure. All right, good, good, good. All right, great, great. We are in the money, as they say. All right, so you guys know me. My name is Dez. You know, I'm a business owner and investor. I've been investing in the stock market for a little over 14 years, probably. I have started investing in options probably about a year ago. The reason why I want to do this course and why I'm so into options right now is because I see how powerful that they are and how you can really amplify the gains in your portfolio. The reason why I made this course and I'm teaching it is because I want to become better at options investing. I want to be able to really understand the nuance on a very tight level. And I think the best way to do that is to really dig in with research and, you know, be able to articulate it in your own words and present it to other people. So even though this course is free, I'm actually getting quite a bit out of it. And that's why I'm doing it. I want to not only really help other people have the gift of being able to understand how options work, but I want to be able to develop it for myself and be able to do better with it. So this is the stock options trading course, and we're going to just dive right in. Real quick disclaimer, nothing that you guys are going to hear here is investment advice. It's just for educational or entertainment purposes only. Options trading is very risky. You have a chance of losing all of your money on an options trade. Can you excuse me, Olivia? All right, 1 minute, guys. I'm working, okay? I'm working. Oh, here it goes. All right. All right, sorry about that. I got some young kiddos there. All right, so yeah, I was saying options trading is inherently risky. You do have a chance of losing all your money. Don't do that. Make sure that you know the details before you take any trade. So we're gonna dive right in. What I'm gonna try to show you guys here in this next 30, 45 minutes is ways that you can trade options to turbocharge your portfolio, the types of options and how they are used, calls, puts, buying, and using the combinations of these to protect and manage your portfolio, and how risk, time, and other factors affect the price of an option, okay? So we're gonna dive right in here. All right. So here's some of the benefits of using options in your portfolio. Options can provide income, okay? Selling of options allows you to let someone else take on risk for guaranteed income to your portfolio. An example of that would be selling calls, selling covered calls, or selling puts, okay? Most people talk about buying options as a speculative mechanism, but you can actually sell options on stocks that you already own for income. And I'll actually go into the options chain and show how that works later on. Options can provide leverage, okay? Buying of options allow you to take on leverage and leverage your capital, which increases the potential upside of an investment. So you can buy call options, for example, and use that to control more shares than you would be able to control for a less amount of capital than you would be able to control if you just bought the shares, okay? And before I keep going, I just want to kind of talk real quick about what an option is. Most of us, already know what an option is. You've probably heard the term, keep your options open. And that's exactly what it is. You can do something, but you don't have to do it. Okay. So options allow you to have the ability to where you can, you could buy a call option and then you have the ability to execute it and take the shares, but you don't have to do that. You pay the premium to have the option to buy the shares in the future, but you don't have to. And when you're selling an option, you're giving someone that ability. You're giving someone the option to buy the shares from you in exchange for premium, in exchange for income. Okay, so that's kind of what options are. If anyone has any questions, by the way, feel free to stop me at any time, or I can unmute you and you can ask a question. I do want to keep this kind of a fluid discussion. Keep going on. Options allow you to calibrate risk in your portfolio. Okay, so how I think about it is you have seen the music producer and, they have all the different, little dials that they can turn to calibrate the sound with the music. Options are very similar in that they allow you to define very specifically the risk to your portfolio. So by using combinations of calls and puts, you can define the risk of a particular trade. And that's something that hedge funds do, a way to hedge their portfolio. And that's something you can do with options. All right. Now, the two major types of options, really the only two options, are calls and puts. Okay. And you buy and sell calls and puts. And all complex option strategies are combinations of calls and puts. Okay. Anything you've ever heard before, calendar spreads, debit spreads, credit spreads, iron condors, butterfly spreads, all these different, unique option strategies are just combinations of buying calls and buying calls and puts, selling calls and puts. All right. So I'm going to go to the next slide here. And if anyone has any questions, feel free to stop me or interject if you'd like. And so we're going to talk about a call option. Now, a call option gives the owner the right, but not the obligation, to buy an asset on or before a certain date at a certain price. With this call option, it's a bullish. You're usually, if you're buying a call option, you're bullish on the stock. You think that the asset is going to go up. Okay. So call options allow you to have leverage to experience the upside of a stock without actually owning the shares of it. Generally, when you buy a call option, you want the stock to go up in value. And you can hold the option until the expiration date and take delivery of the stock. Okay, so that's kind of sort of the basic rundown of what a call option is. Now, buying calls, strike prices, and making money by expiration dates. When you buy a call option, you're paying a premium for upside potential. When you sell an option, you get paid premium, okay, to give away your upside potential. How I kind of separate selling and buying calls is like if you've seen the Wayne Brady show, where there's a door number one and a door number two. You guys have seen the game shows where there's door number one and door number two. And door number one opens up and there's a washer and dryer, right? And you know exactly what you're going to get. You're going to get a washer and dryer if you pick door number one. But door number two, you don't know what you're going to get, right? You could get a brand new car. You could get a washer and dryer. You could get zonked and get nothing, okay? So that's kind of the difference there. I would say door number one is like selling calls, where you know exactly how much premium you'll get paid, okay? And I would call door number two buying calls, where you don't know exactly how much you could get. You could get infinity money, or your call could expire worthless and you could lose everything. So that's kind of like a little analogy that I use for buying and selling options. Now, in the money, out the money, or at the money. These are terms that describe what your option is relative to the stock price, okay? So we would say that your option is in the money if the stock price is lower than the, or I'm sorry, if the stock price is, if you're doing a call, if the stock price is higher than the option, your stock price is in the money. Your stock price is at the money if the strike price and the stock price are the exact same, and your stock price is out of the money if the stock price is less than the strike price. Okay, so I hope that that made sense there. I am going to just jump into an options chain real quick to kind of show in the money, out the money, and that thing real quick, because I think that's really, really useful to see. So I'm going to go to share screen here. I'm going to go to my Webull, and then I'm going to, let's see here, open up the, let's see here, see if I can open up the options chain here so that you guys can see it. One moment. There it is. All right. So what we're looking at here is the options chain. I'm on Webull. All apps are going to be fairly similar. I'm going to go to Apple. Apple is a stock that people are very familiar with. And when you're looking at the options chain, you're going to see a bunch of numbers here. But what the number that you're going to focus on here is the stock price. Okay, so we see that the stock price of Apple is $135.37. Okay, so I would call this option right here that is closest to the stock price as at the money, this $135 strike call. Okay, these are February 19th is the date that these expire. But this, I would call this one at the money. Okay, this one here, this 140, okay, this strike price is above the stock price, so it's out of the money. Okay, and I would call this 131. This is what they call deep in the money. So the deep in the money means that you're going to get paid, that you're going to make money on your call. But if it's out of the money, and if it expires by, if it goes to February 19th, you know, say it doesn't, you buy this one here, this 140, it doesn't go there. And that would mean that it would be out of the money. Okay, so that's kind of the difference there, in the money, out the money, and at the money. Are there any questions on that real quick before I jump back into the other side there? Just let me know. All right. Looks like
I was going to add as well that what you're talking about is like more theoretical, but obviously like I assume you're jumping into the Greeks later, because when there's theta and when you buy it, like, so for example 135, but then like 2 months go by and it doesn't go above 135, you're going to be out of the money, obviously. So, but I assume you're covering that.
That's exactly right. Yep.
Yeah.
That's definitely right. Yeah. This is,
Yeah.
you know, more of kind of the theoretical, sort of the
Yes.
broad base, like, you know, we're going to get into theta and the Greeks definitely too, but that's exactly right. You know, it probably would have been better if I would have selected one further out where theta probably wouldn't have, theta doesn't have as much of an impact on it. But that's a great point,
Cool.
especially on these weekly options. Theta is a huge factor in those. So that's awesome there. All right, so let me go to the other screen again here. All right, we are back. All right, so we're going to keep going with these slides. Go to the next slide here. Oops, wrong button there. All right, let's see here. Okay, selling calls and making money by expiration date. Okay, once again, whenever you're selling an option, you get paid premium. It's like you earn an income off the underlying shares that you have. And whenever you're selling a call, it's actually a bearish position on the stock. You're essentially shorting the stock. You don't want your stock. You don't want the stock to go in the money, because or deep in the money, because you're going to lose all the money that you would make from the time that it's at the money and above. You know, you get paid the premium, but you sacrifice your upside gain. Okay. And so if the stock price is greater than the strike price and it's in the money, your profit is going to be the options premium that you're paid. okay? And the difference between your cost basis and the strike price, I need to spell that better. So what that's saying is that, say you have 100 shares, okay? And I'm gonna actually show this example on the options chain, because it actually makes a lot better sense to show on the options chain. I'm gonna go back to Webull again, okay? And then say I have 100 shares of NEO, right? I'm looking at NEO stock here. Say I bought 100 shares last week and I have the shares at $55, okay? Say $55 is my cost basis, right? And I want to sell a call on my position. And say I don't think that NEO, or I'm willing to sell NEO at $62 a share for this week, or I don't think that NEO is going to go above $62 per share. So I could go in here into the options chain. I could go into, let's see here, sell this call here. And then if I were to sell this call, I would earn an income of, looks like to be about $111 for 1 week, just selling that call at the $62 strike. So that's kind of an example of what that is. Now, if NEO goes to 65 or 62 or 63, then I don't make all the money that I would make if NEO was at, went, if I didn't sell the call. I only make the money between 59, or my original cost basis of 55 and 62. I don't make any of that extra money. So I hope that makes sense, that you're selling your upside potential for a guaranteed income. And what's cool thing about selling calls is that the money gets put directly into your brokerage account immediately. And you can use that for buying more shares. You could use that for whatever you'd like. You could pull that out and pay bills with it, whatever you'd like to do. It's a really, really nice strategy. And I actually don't think it's talked about enough. I think that everyone talks about buying calls and buying options, but they never talk about selling options. So I did want to focus on that a little bit. And if there's any questions or anything or comments, feel free to stop me. But I'm going to keep going here into put options. All right, so put options. This one is for the bears. Whenever you buy a put option, it gives you the right to sell 100 shares of stock at a price, at a determined strike price. Buying a put option gives the holder of that option downside protection. Okay, it protects you against your stock, crashing, right? I would say probably one of the most famous put options ever was Mark Cuban, right? He had made hundreds of millions of dollars selling Broadcom, and then used that money to invest in the stock market during the dot-com bubble and earn billions of dollars. And how he protected his portfolio during the downside crash of, the dot-com crash in the early 2000s, was he bought put options on these stock indexes. So he was able to sell his portfolio at a fixed price by buying those put options. And it's a really famous put option example. And so the opposite would be selling a put. And selling a put option gives the seller the right to buy 100 shares of stock at a determined strike price. So you are selling insurance for someone else. A really nice strategy with selling put options. Say you have a stock that you want to own 100 shares of, but you don't. You have, you want to buy 100 shares of Apple, right? You have the $13,000 that it would take to buy 100 shares of Apple, but you don't want to buy it at 137 per share. You want to buy it at 125 per share, right? So you could go into the options chain, and I'm going to do that again with the puts so that you guys can see the put options here. You could go to the options chain. You could open up your Apple, okay? You could say, all right, I want to buy Apple at $125. You would go to, let's see here, you go to the puts. You go to selling one put, and let's see here, you pick the strike price of 125, okay? And then for selling that put, you would earn $66 per. Not sure if I did a monthly or a weekly there, but it looks like about, yeah, monthly, looks like a 2 week there, but you would earn $66 just for creating that option out there, just for protecting an investor for selling their shares at 125. So that's a nice strategy too. If Apple comes down to 125, you can execute that option and take those shares. Or if it stays above 125, you get to keep that options premium as income and then do it again next week or next month or whatever. So that's a nice way to make a guaranteed income off of some cash that you have sitting in your portfolio there. Selling put options is a great strategy. So just wanted to show that. And like I said, if there's any questions or comments, feel free to stop me or anything like that. We'll have this thing unmuted so anybody can talk if they'd like. All right, so the next thing we're going to go into is the Greeks. The Greeks are very, very important. They tell you how the different factors affect options price. Okay, so the delta is shows how close the options price follows the value of the underlying security. The theta is the time decay of the option. The gamma is the rate of change of delta relative to the price of the underlying. So the gamma, if the delta is like how much the options price follows the value of the underlying security, the gamma is showing how much that changes relative to the change of the price. I wouldn't focus on it too much, but really delta and theta are really, really the big ones. Vega as well, it represents an option sensitivity to volatility. And rho, it's not too important, but it represents how options are sensitive to interest rates. I'm going to show you guys real quick on the options chain how those are important here. I'm going to jump in it real quick. All right, so we are here looking at Apple here. And let's see where we can see our Greeks on our apples. Okay, so what I did is I just went to the calls. All right, so say I was looking at, and I like to do long-term calls. I don't really do short-term calls because I think long-term calls are a lot less risky. But say I wanted to buy a long-term call option on Apple, okay? I could buy maybe the $130 in the money call option, okay? And then you're gonna see over here, you'll see the delta, the gamma, and the theta, okay? This delta being 0.6, that means that for every dollar that Apple would go up, I would earn $60, okay, on this option. All right. The theta here of -280 means that for every day I lose that'd be $2.80 on that option. That shows you how much money that you lose because the option is deteriorating in value because of time. Theta is very important, kind of as Winston said, especially as we get closer to the expiration date. Okay, so if you can imagine that, the longer term that you have, the more chance that your option has the chance to get into the strike price. So the theta is not as big of a deal. But whenever it gets close to the expiration, the chance of the option getting into the strike price is less because there's less time. And so that's what's represented by theta. It's expressing the less chance that you have of actually making it to the strike price. So it's the time value of the option. Let's see here. That kind of sort of explains that. One kind of analogy I like to use, with the theta is, if you were, say, a movie producer and I had, written a movie script or something, and then I came to you and I said, will you buy my movie script from me? And then you were like, no, I won't buy your movie script right now, but I'll buy the option for your movie script for 3 years, right? I'm going to charge that person more money to buy my movie script for 3 years than I would charge them to buy the option for it for 1 year, right? So the longer term that the option is, the more expensive that it is. Okay, so that's kind of why I'm sort of trying to say that there. So I'm going to go back to the PowerPoint, and we should be getting pretty close here. So, all right. I will go to a buy call option example, but here's the buys and calls and puts cheat sheet. As you know, buying a call is to buy the upside. Buying a put is to buy insurance that pays you if the stock drops. Selling a call is selling the potential upside of my stock to someone else for income. Selling a put is selling downside protection for someone else. Okay. All right. And how to make $100 per week selling calls on Apple example. All right. So this is really probably the last slide I'll do here, but let's see. Thank you. All right. All right. So, say you have 100 shares of Apple, right? Okay. So you could go to the weekly call options, and a lot of people do this. I like weekly call options on stocks like Apple, stocks that are trending up and have high beta, have high, volatility and open interest. So you could sell, this example here would be the 137 call option on Apple. Okay. You could sell that this week and earn about 95, somewhere between 95 and $100, kind of depending. And this kind of goes into when is it a good time to actually sell call options. And it's really whenever a stock gets kind of overextended. So say Monday morning, Apple jumps up to 137, for just because of the volume in the market or something like that. You could jump in real quick, sell the option at 139, earn $100. Apple may come back down to earth and come down to 135 or 134, and then you get to earn that income. I like to sell call options after a big run up, okay? Because when you're selling a call option, you are essentially taking a short position on your stock. So you don't want to sell your call option right before it runs up, because you're going to miss on that upside potential, and the value of the option is going to increase so much that if it goes over the strike price, you'll have to flip out of it, or end up losing a lot of potential gains. So that's kind of selling call options on Apple. Another great stock to sell call options on is like Neo. Tesla is great. Palantir. I really like high beta technology names. I think that, you want names that have a lot of high money flow, that are trending upwards, names to where if you don't, pick the right strike price when you're selling the call, it's still not a big deal because your stock is trending up so much anyway. But that's that. Here's some of the other ones. AMD is nice for that. I do calls on AMD. I sell calls on FCEL. Riot, Mara, save companies with high volume. Volume is really important with options because they're traded a lot less than stocks. You may have thousands of options traded at a particular strike price in a day, rather than millions of shares of stock in a particular day with a certain stock. So high volume is good. And the wheel strategy, I kind of sort of talked about that a little bit. The wheel strategy is where you have your money in your account. You have a stock you want to buy 100 shares of. You sell the put on those 100 shares. Your put gets executed, and then you buy the 100 shares, right? And then you sell calls on those 100 shares. And then you just do that over and over and over again, collecting income on your 100 shares there. And that's pretty much it. I hope that this was helpful. It kind of, if anybody has any questions or anything, I'd love to, I could go into the options chain more or anything like that. Zoom gave me a gift and told me that I could continue this call as long as I want. But, I hope that this helps out a little bit. Let's see here. But if no one is going to have any questions or anything like that, I'll probably just, put this recording on the investment channel, and we'll probably be talking about stuff more. If I love talking about options and stocks and things like that. So, if you ever want to message me or something like that, with a particular play or something that you're thinking about doing, I'd love to talk about it and give my opinion and stuff. And, hopefully we can make a lot of money with this stuff. With selling calls on my stocks, I've been able to earn at least 1 to 2% per week on the stocks I'm selling calls on. And 1 to 2% per week is really able to add up quickly. I think that a lot of people are very, very short-term minded, and I think that if we as investors really think about the long term, it's gonna pay off very, very good for us. One thing I like to do with folks is like I'll come on to I'll come on here and then I'll go on to compound interest calculator, and I'll do that on the investor.gov, and it's really powerful the amount of money that you can make in whenever you put just a small amount in over a long period of time. I have here, you put $5, you start with $5, and then you put $5 in the stock market every day. So that would be, there'd be 30 days in a month, that's $150, 30 times five. And then you put the estimated rate that you're going to earn on your money. Most people think that you will generally earn around 8 to 12% on your money annually. But with these sort of strategies, option strategies, knowing how to do entries and exits, picking proper lot sizes and things like that, you can actually earn significantly more. So I'm going to put that, maybe let's call that 30%, right? Okay, and then we'll compound that. Okay, so in 10 years, you would have $76,000. And if you did that for 25 years, okay, you'd have over $4 million. Okay, so it really, and that's just putting in $5 per day, $150 per month. Okay, you can earn just ridiculous amounts of money with very, very little input. It has it putting in $50,000 here, but it grows, exponentially. It really, really does. And that's really shows the value of time. Time is the most important factor as an investor. And, the longer that we do this and the more that we stay in the game, the more wins that we're going to have. Taking really high risks on options and losing a lot of money, buying weekly options and losing a lot of money is a bad way. You'll blow up your account. And if you blow up your account, you exit the game. And if you're not in the game, you're not able to achieve these really, really spectacular outsized returns. It's kind of shocking how much, how much these things, how powerful this works here. But with that, I'll kind of end it today. I hope that this was helpful for you. I hope that you're able to make lots and lots of money in the market. Like I said, thank you so much for watching, and
Hey,
have a
Des, can
great
you hear
rest.
me?
Yes, sir. Yep.
Hey, I do have a quick question for you. Sorry, I joined a little bit late. I have a question on buying and selling puts. So I have an understanding of buying and selling calls. I think a decent understanding. I've made some money doing that. I've lost some money doing that. I still haven't wrapped my head around buying and selling puts. Is that something you could go into a little bit more?
Sure. Yeah, absolutely. So when you're selling a put, okay, you are giving someone else the upside. I'm sorry, you're selling insurance for someone else. Okay, so when you're selling a put, you are giving someone insurance in case the stock goes down. So let's take a look at the options chain here. Can you guys see the Webull?
No, not right now.
Oh,
It's your compound interest calculator.
okay, let me go on the Webull here. All right. So say I had Tesla, right? Okay. And say I had 100 shares of Tesla, right? And Tesla's a very volatile stock. I'm nervous. I'm nervous. Elon Musk might say something crazy. The stock might collapse. I don't know. It's already run up so much this year. I'm nervous. I don't know how. I want to protect my portfolio, right? So what I could do is I could buy a put option on my Tesla shares. I have 100 shares of Tesla, and then I would go into this here, and I would be like, okay, I want to definitely get out of Tesla if it goes to 750. So I would go to options here. I would go to put. I would pick my strike price of say 700. I'll make it 700, and then I'll do one. Okay. And so for me to buy that put option that would protect my portfolio, okay, that would guarantee I would sell my Tesla shares at 700 if it went down that low, I would have to pay, looks to be about, let's see here, one, two, that'd be 15,850, right? Okay. And that's a lot of money, right? But if Tesla goes to 500 or 400 or something crazy happens, then I win on that trade. Okay, so that's kind of buying a put. It protects you on your stocks. Like say you have the Riot, you have a lot of Riot. Let me look at Riot here because that one might be actually pretty interesting to buy a put on. So I have my Riot shares. Riot's been on an incredible run. It's up over 100% in a week. I want to protect myself on my Riot. I don't want, say I want to sell 100 of my Riot shares if Riot was to go down to 45. So I would go to Riot, I'd go to 45 put, I'd go to buy, I'd buy one of them, and then I would pay $730 for the right to sell my 100 Riot shares at 45.
So even if Riot went down to $10, you're still selling it for $45.
That's correct. Mhm.
Got it. Okay.
Yep. And then the selling of the puts is the same thing, but the opposite. It's like you're the insurance person and you are getting paid your insurance premium for giving someone the right to sell those shares to you at a certain price. So with selling puts, say you have $4,500 and you want to buy 100 shares of Riot, right? You don't want to pay $4,900 because it's $49.28 right now. You want to pay $4,500, okay? So you'll take your $4,500 and you'll sit it in your account, and then you'll come on here and then you'll sell the $45 put, right? You'll sell one of those $45 puts, and then you'll get paid, this $655 to sell this put. And if Riot doesn't go down that low, if it stays above, you still get paid that premium, but you don't have to buy the shares. It's only if it goes below it that you have to buy the shares at that amount. So it's kind of the opposite with like selling calls. It's like you're protecting someone else. So hopefully that makes sense there.
Gotcha. So in that scenario, even if Riot were to go to say $20 a share, you would be forced to buy them at 45.
That's correct. Yep. Mm-hmm. Yeah. Which would be good for the person who bought it, but not good for you as the person that sells it.
Yep, absolutely.
Kind of like how whenever you're like selling a call, if Riot went to 100 when you sold the 50, that wouldn't be too great. But if it's 51 or something or 45 or something, it's not a big deal.
Yeah, and then like this last week, we would be scrambling to buy them back.
Right. Yeah, like how we were this last week.
Multiple times.
Yeah. I bought them back the one time and just gave up on it. I was like, man, that motherfucker might go up to 55. Who knows where he's going?
Yeah.
Mm-hmm. So yeah, any other questions or anything on this stuff? Those were great stuff. I honestly don't do very much with buying and selling put options. I really don't. I really don't. But I know that they can be pretty good. I don't mess with it. I usually am just doing calls. I'm buying calls or I'm selling calls, and I'm usually buying leap calls. I really like, even though they're way more expensive. I love leap calls. One of my favorite things to do is called a calendar spread. Okay, and with a calendar spread, what you do is you buy the leap call, the deep in the money leap call. So I'm looking at NEO here, right? And I'm looking at the calls, all right? And this deep in the money leap call is at $45, and it has a 0.8 delta. And that would mean that for every dollar that let's see, your NEO would go up, I would make $80 because you move the decimal over twice. Okay. And once I have that option, right? Once I own that option, I can also sell calls against it. I can sell short calls against my long call position. So I have this option here now. I then go to the short calls, right? I go to the February 19th calls, and then I could sell maybe the $63 call against my $45 call, right? I could sell the option that says NEO is not going to get above 63 by the end of this week. I could collect my my premium here. Looks to be about $89 in premium. And then I could use that money to buy more shares. I could use it to buy more calls. I could, it's really, really cool. I love the calendar spread strategy. It's also, I guess, called the poor man's covered call. Is a nice strategy on that. But
so in order to do that, how far out do you have to buy the call?
I think it's at least 6 months. I'm not sure exactly.
Okay.
Winston, do you know how long with a calendar spread, how long you have to like, how far out it has to be? I all of mine are at least a year. I at least even 2 years. I can even show the ones I have, but
Yeah, my knowledge is basically just 1 or 2 years, or well, at least
mhm.
a year basically.
And another question I have that you might know is if the okay, say Neo gets to 63, right? And you have a long call. Do you have to execute your long call and then to execute your short call? Do you know how to unwind like a position like that?
I do not actually. I mean, the only thing I was aware of is if you want to roll options, it's no different than just basically exiting your position and then re-entering the position at a different price, basically.
Hmm. Yeah, so that's kind of something that I was. So whenever I do my calendar spreads, I always pick a strike price that's just crazy. Like if I was doing it on Tesla, I would pick like the 950 strike call to sell or something. Something that's has a very low chance of actually happening, because I don't really want to be in the position where I'm forced to execute my long call to pay for my short call. I really want my long call to just sit as a long call for as long as possible and increase in value over time. Let's see. Any other questions or thoughts or stuff about options here? Any options y'all want to look at?
Can you jump to Riot real quick?
Okay.
Okay, so when I was purchasing my calls back on Friday, I ended up buying an additional one. So I now have 500 shares of Riot, and that's really really heavy on my overall portfolio. I don't want to keep 500 shares of Riot. So what I was considering was selling on Tuesday morning at open something that would be in the money just to collect more premium on it, knowing that my shares will go away. Is there
Mm-hmm.
any real downside to doing that?
No, that's actually a strategy that people use all the time. What I've heard is the most valuable that an option is going to be is whenever it's right at the money. So, yeah, if it were me, I would wait till the market opens. If Riot, gaps up to 51 or 52 because Bitcoin stays strong, I would sell the one as close to at the money as possible, and then maybe it might come back down to earth. But it's like the highest. It's like there's like a function or something, but it pretty much comes down to the best one. The one that you're going to get paid the most on is the one that's directly at the money, rather than going like way deep in the money and then selling those. You could sell one of these as well, way deep in the money. What people do with those, I think this gives them downside protection as well, to
Yeah.
sell the calls whenever it's selling it deeper and deeper in the money. But yeah, that's a great strategy. I've done that before to get out of some of my NNDM, because I have a lot of NNDM. I have some like 1,000 shares of NNDM, and I thought that was too many. So I sold two of the $15 strike calls that expire on the 19th. And if they get executed, that's good. If they don't, that's fine. And then the rest of the calls I'm going to sell on Tuesday, and they'll probably be like the 20s or something like that, or the 1750s or something.
Okay.
Mhm.
So when you're selling calls, you'll typically try to do it Monday morning. If you're doing a weekly one, you won't wait until later.
It actually depends. One of the things that I like to look at is how the stock is moving. Like you want to sell the calls when the stock is at the peak. It's like sell high, buy low. So
Yeah.
and that applies with selling calls and things like that too. So ideally you want to sell the right call when Riot runs up to 49 and is coming down to 4 and is coming down to 48, even if that's Thursday, right? Because really with Riot, the calls increased in value all week long. to where they were only crushed on Friday whenever, Theta finally made them either worthless or in the money. But yeah, so what I've noticed is you want to do it on big runs. Sometimes what I'll do is I'll go on to, let's see here, I'm going to go on to my Safari here. I'll go on to my, let's see, okay, my trading view. Okay, and then I'll look at, and I figure out how to sell my calls a lot of times from trading view. I think that this is a really great tool. This made me figure out to sell the 850 call this week because Tesla was looking so weak. But what I'll do, I'll go into the trading view, and then I'll open up the where's the thing called? It's like the indicators. And I'll open up the RSI, and then I'll open up and then I'll bring this down here, and then I'll go into, let me go into Riot. And you guys can see this, right?
Yep.
Okay, nice. All right. So I'll go on to Riot here, and then I'll be looking here, and I like to use more longer term charts first, and then I zoom into more detailed charts after that. And so looking at right here, I would draw some lines of action here. There's like a really short-term support there. There's probably a longer term support, probably about right in this area here. Okay. This gap here was, I think, the Elon Musk news that Elon Musk was buying into Bitcoin or something. Okay, and so I'll draw like a resistance like here. Oops. Yeah, I'll draw the resistance, and then I'll turn the resistance red. And so looking at this, I'm considering to try to sell the call at 52. Or if it like breaks over 52, because and if Bitcoin is still like less than 50,000, I'm selling it at like 52 or something. Or what I'll do is I'll go into the 15-minute candles, and it's Monday morning. Let me see if I can go to Monday. Let's see here. All right. I'll go to Monday morning. The 11th was, I think that was Monday. Okay. And so this gap up here, this would be a great time to sell the call, you would think, because, right, it just immediately gapped up.
Yeah.
But then it just kept going. It just kept going. And then, you draw resistance right here, right? And then it breaks through that. And then you would think that this would be a decent time to sell a call, but then it just kept going. And so like, with this stock, it would be kind of hard. There was really not a very good time to sell a call on the stock. Except for, I guess, here, but that was here, 52, this would be the perfect time to sell the call, for that would have expired on Friday.
Yeah.
Because this was when it was the most valuable. But that's what you're looking for. You're trying to sell the call on the peak. That's for really extracurricular type gains, because you're getting paid regardless, but you get paid a lot more when you sell the call when the stock is at the top.
Yeah.
Regardless of the day of the week, usually, especially on these type of names that have a lot of volatility. A stock like that doesn't have very much volatility and things like that, it might be better to sell it on the Monday, or sell it on, just whenever you can, because theta becomes a much more important metric on stocks that don't have the volatility to just move massively in a short period of time, like really all the stocks we trade. I mean, we trade pretty volatile stocks, but I like that. I think that volatility is life. Michael Saylor said that, and I agree with him 100%. You want volatility, means that stocks are getting traded, that there's lots of money flow, that things like that. Apple's looking pretty nice right here. I'm liking this Apple. I like this volume here.
Does TradingView allow you to overlay one stock on top of another stock?
Yes, it does. It does do that.
Can you overlay crypto on top of the stock?
Yes, you can. Yep.
I'd be curious to see Riot against Bitcoin.
Let me see if I can fix this here. Go into it. I think I can do that.
Or even right on top of Mara.
Yeah. And we lost your screen also.
Yeah, let me fix it here. Share
Okay.
screen. All right. With the right one. Riot on top of Mara. Okay. Let's see here. Compare symbols. I got Riot. Okay, and then I got Mara. Okay, and then I got Bitcoin. Actually, I'm going to do it a different way. I'm going to go to BTC. You guys can see this, right?
Yep.
All right, nice. All right, here we go. All right, so I'm going to make this chart a little bit bigger. 4-hour chart here. Every candle is 4 hours. All right. Let me get where's my little controller here that makes me do this thing. All right. There we go. Okay. All right. As you can see, these arbitrage plays, these Riots, these Maras, these the MSTRs, the everything has really decoupled from the price of Bitcoin in a major way. Riot has really outperformed Mara, and I think that has a lot to do with Riot's increased capacity. Riot can do a lot more, like, Riot can mine a lot more Bitcoins than Mara can. But Mara has more Bitcoins than Riot does because they spent all of their reserves on Bitcoin. But it's interesting to see the growth of these. Any others?
What I was trying to correlate, and I didn't have any success with it, but let's say Bitcoin hits 50,000, what does Riot become? But I don't know that there is a direct correlation between them.
Well, okay, so let's see here. Riot has done 642% better than Bitcoin has, and then Mara has, so about 6 times, and then Mara has done about 4 times, apparently, according to this. And so I would say that if Bitcoin went to 50,000 and right now it's 48,000, Riot's probably going to go, what, it may just make the amplified move. It just, it probably, Bitcoin at, let me see if I get these out of here.
So that's as of December, like your starting date on that graph is December like 9th or something. If you did it like for 2021 or even like after that weird spike for Mara, then you might have it look more even.
Why isn't it going all the way to 20?
It looks like about 12 o'clock on Friday, Riot hit almost $53. I'm not sure where Bitcoin was at that time. I think it was like 46.
Yeah, but Bitcoin has been a bit flat, I think, and Mara has gone up a bit more because I think Mara has some other cryptos like Ethereum and stuff, and Ethereum has been going up since Bitcoin was consolidating before that recent surge.
And I will say too, like, the more overextended they are, the more chance that they have to drop. They become, as the price gets so disconnected, like, the risk becomes a lot higher. But I honestly think Riot and Mara are very safe long term. I'm kind of the person that thinks Bitcoin's going to be like 100K this year. We might look at $1 million Bitcoin in 20 years from now or something crazy like that. So I have no problem just holding them, even if they come down a lot. We're sitting on so much gains that it's probably going to come back up. So
Mara has hit all-time highs, right? Or one of them had all-time highs at like $45 back at the last halving event. I forgot which one of the two it was. But obviously, I'm expecting it to shoot past it.
The last halving event, do you know when that was?
2017, 4 years ago. Or either 2017 or 2016. But I think the last
Mhm.
peak was at like 2017. Wait, which one's this one? Mara?
This is Mara.
Oh, so for some reason it's showing even higher
So,
before
yeah,
that.
but it could have had splits, or it could have had
Yeah,
share
that's true.
dilutions and things like that. I
Yeah.
suspect that it did.
Yeah, so the peak I was looking at is basically like right there where it's like at the end of like Q4 of 2017.
Yeah.
Yeah, that's like a level that if it passes it, it might shoot above it a lot, or it might sort of consolidate there and then make the next leg up. But that's a level to look at least.
Yeah, for sure. For sure. This is definitely a really important level here. I like it. I like that one. And then this one's going to be important after that. Nice. Any other tickers?
I was going to mention as well, I think you talked a little bit about volatility. I'm not sure if you covered it maybe earlier, was like when it comes to buying calls or exiting your positions for calls that you buy, typically the volatility is like really crazy at like opening bell or closing bell. So when you try to buy, like try to make sure that like the volatility is low. Otherwise, you're buying when Vega is like really high, and then you're buying a price that's like gonna essentially like calm down later, and you're gonna end up losing money. But then when you're trying to exit your positions, like say for example, you bought calls that were at like $200, and then the price like 2 weeks later is at I don't know, $800, so you've made 400%. You want to sell when the volatility is high, so at like in the first thing in the morning or late in the day. Otherwise, like when it's calm around lunchtime, you're going to end up making less because Vega is less. So
Yep, that's exactly right. Yeah, for sure. Yeah, I that's exactly right. I don't like to buy them, right there at the beginning of the day, because that's when, especially on a Monday, because that's when or unless it's such an expansion channel. I mean, this market has been so bullish. Like it's like, stocks will gap up in the morning and then they'll just keep going. If that happens, then you can buy them at the beginning of the day. But yeah, you really want to buy it whenever they're at their lowest and whenever the volatility is the lowest, because the volatility is going to it's going to make your option be more expensive. Just that factor.
So what do we look at to see the volatility again?
Go in here, new share.
yeah, if you're on that screen in Webull where you had like Delta, Gamma, Theta, and Vega up, you can pull in implied volatility as well.
Yeah, so okay, so you guys see this here.
Yep.
So I'm gonna go to okay, I'm on Riot. I'm gonna look at these February 19th. These are good to look at because we're probably gonna be playing these a little bit. So let's see here. Yeah, the implied volatility is just crazy. These like I mean, they're 100. I mean, they're these are just 200+%, volatility. I mean, it's very high. It's
So
very
on
high.
a stock that doesn't move as much like Apple, what would the implied volatility be there?
You see here we got a 26%.
Oh, okay, gotcha.
And then I'll go look at Tesla. Tesla about 57%. The volatility on Tesla has been going down. The premiums on selling calls on Tesla has been decreasing over time because the volatility has been going down.
Is it possible for you to go retroactively to whatever time in the past as if that was real time? Because so for example, on the Thinkorswim, there's like an on-demand button. So like I could literally hit like Friday, I could hit like first thing in the morning at opening bell, and I could see the volatility, and I could like fast forward to like lunchtime and look at volatility. And instead of comparing volatilities of different stocks, I compare volatilities of the same stock at different times, if that makes sense.
Yes, that's awesome. I don't know if there's a way to do this or not. Let me see. I don't know if there's a way to do that or not. I have heard that you can do that on Thinkorswim, but
yeah, it's pretty useful so that you can figure out like, even if it's comparing other companies, you kind of don't know. Like for example, for Tesla, it might be at like 60 all the time, but like if it goes to like 75, maybe that's actually a huge jump for Tesla. You don't really know unless you see it historically.
Yeah. Yeah, I don't know if Webull has that tool or not, but to be able to do that would be very helpful. I've actually thought that using that would be really good. Like sometimes, like where it was like where you can actually like go back in time and actually
Yeah.
see how these different factors have changed. Like go back and do it in real time.
Yeah. Sometimes like early in the morning, I'll like if there's something that's gapping up, and I think like you were mentioning, where even though it's gapping up, it's still gonna keep going. I'll try to look at maybe like for example the last time it had a gap up, and I'll look at the same time to see like how that volatility was. And if the volatility was pretty low at current time, I'll be like, oh shit, like I'm gonna actually buy this because it hasn't reached that high volatility like it has in the past gap up. So
No, that's great. That's great. And that's kind of one of the reasons why I want to check out Thinkorswim. Like, it seems a little complicated, but it has so many more tools that this one has. And also what I don't really like about Webull is it's a newer broker as well. And newer brokers, I think, are still subject to possible liquidity issues like how Robinhood had, Webull kind of did the same thing where they kind of limited certain stocks, but they weren't so loud about it. And, they weren't all in the news about it. And I'm kind of thinking that, more brokers that have been around for a long time, your E-Trades, your TD Ameritrades and things like that, or Vanguards and stuff are going to have a lot more money in the bank to where they could cover a margin call and not, have to limit stocks and things like that. I sort of worry about that a little bit because I have a fair bit of money in Webull here.
I do like the pretty clean and simplified interface. Like Thinkorswim is going to be a bit of a learning curve, especially it's just weird when you're buying stuff and clicking around. It's like pretty sensitive to different things because it's built to be a professional traders platform.
Yeah. I love this interface too. I love how Webull is. I love how easy it is to use. I really like the social network aspect to it as well. It's really cool. Price solo 135. But anyway, guys, I'm going to jump off here. It was really, really fun to hang out with y'all today and talk about options. We should do this again next week. I love this so much. Even just doing this has helped me with what trades to think about taking next week. Apple's looking really nice. I really like CRISPR. I got into CRISPR at 153 on Friday, and it's doing so good. CRISPR is a beast. But y'all be cool and stay warm, and we'll do this again.
Yep, sounds good. Thank you.
Yep. Talk to you later, guys. Yeah. Bye.
Yep.